What if I told you some of the biggest brands you once trusted did not fail by accident? They followed a pattern. Kodak, Blockbuster, Sears, none of them vanished overnight. They slowly collapsed, decision by decision, and most people never noticed until it was too late. The mistakes that kill brands leave warning signs. There are 6 of them, and once you learn to spot them, you will see them everywhere. Every brand collapse leaves a trail. When you look closely, the same 6 mistakes appear again and again. First is product neglect. This is the moment a company stops improving what made it famous and lets its core offering fall out of step with what people want. Next comes brand dilution. That is when a brand stretches itself too thin, chasing every new trend or slapping its name on products that do not fit until the original promise gets lost. The third mistake is short-term thinking. This happens when leaders chase quick wins like boosting quarterly sales or cutting costs for a fast bump at the expense of long-term strength. Number 4 is toxic culture. When a company's own incentives reward the wrong behaviors or punish those who speak up, the company drifts into silence and stagnation. Fifth is digital denial. Brands that ignore new technology, refuse to invest in digital tools, or cling to old ways of reaching customers end up falling behind. The last mistake is mishandling a crisis. When trouble hits, whether it is a product recall, a viral complaint, or a bad headline, a slow, confusing, or tone-deaf response can turn a setback into a spiral. These 6 patterns show up before every major brand failure. They are not just theory, they are a checklist. Spot them early, and you have a chance to turn things around. Miss them, and history repeats itself. Luck is never the real culprit when a brand collapses. The evidence shows that it is not one big shock or a single wrong move that brings down a household name. Instead, it is a series of choices, small missteps that add up, compounding like interest until the damage is too great to reverse. Product neglect, brand dilution, short-term thinking, toxic culture, digital denial, and crisis mismanagement are not random accidents. They are patterns that repeat across industries, quietly eroding the foundation of even the strongest brands. Think of these mistakes as signals on a dashboard, not just stories in a business magazine. They appear early, show up in numbers and behaviors, and most importantly, can be tracked long before disaster strikes. When leaders ignore these patterns, they set off a chain reaction, where a neglected product leads to falling relevance, which prompts desperate brand extensions, which in turn confuse customers and SAP loyalty. Layer in a culture that punishes dissent and a refusal to adapt to new technology, and the spiral accelerates. This is why patterns beat luck every time. They offer a framework for spotting trouble before it is obvious. If you are building a brand, these patterns are your early warning system, a practical checklist you can use to diagnose risk and course correct. While there is still time, the next sections will break down how these signals play out in real companies, turning abstract warnings into concrete proof. In 1975, a Kodak engineer named Steven Sasson built something that should have changed everything: a working digital camera. The device was clunky, weighed 8 pounds, and snapped grainy black and white images, but it worked. Sasson showed it to Kodak's executives, who saw a threat to the film business that brought in most of the company's profits. Instead of pushing forward, they tucked the prototype away. For decades, Kodak's board and leadership doubled down on film, even as digital technology advanced around them. By 1997, as digital cameras started to appear on store shelves, Kodak's board met to decide the company's future. The majority voted to protect the legacy film business, choosing short-term stability over a risky digital pivot. That same year, Kodak began cutting its research and development budget. Research and development spending dropped by 15% between 1995 and 1996, even as competitors poured resources into digital. The company's patent filings, once a source of pride, slipped by 12% in the early 2000s, a red flag that innovation was drying up. When the dam finally broke, Kodak's response was to sell off its patents. In 2012, the company sold over 1,400 digital imaging patents for $525 million, a movie analysts read as a last resort. By then, the brand that once defined photography had filed for bankruptcy. The warning signs were shrinking research and development, a falling patent pipeline, and a board unwilling to let go of the past. They were all visible years before the collapse.
Kodak's decline wasn't sudden. It was a slow-motion unraveling set in motion by a series of cautious decisions that quietly drained the company's future. Blockbuster once sat at the top of home entertainment, with more than 9,000 stores and a business model that squeezed every dollar from late fees and in-store rentals. In 2000, Netflix approached Blockbuster's board with a $50 million offer, a chance to buy the upstart and fold its online DVD by mail service into Blockbuster's empire. Board members dismissed the proposal, confident that their brick-and-mortar dominance and steady late fee revenue would outlast any digital novelty. At the time, late fees alone made up nearly 30% of Blockbuster's revenue. The company doubled down on opening more stores, chasing short-term cash flow instead of questioning whether the world was changing under their feet. By 2007, Netflix had launched its streaming service. Blockbuster scrambled to respond, rolling out its own digital platform. But the effort was underfunded, and it arrived too late. The leadership's focus remained on extracting value from physical stores, even as foot traffic slipped and customer habits shifted online. When the company finally tried to pivot, it was weighed down by expensive leases and shrinking margins. In 2010, Blockbuster filed for bankruptcy, unable to recover from years of distribution inertia and missed opportunities. The refusal to adapt, to recognize that distribution models can be disrupted overnight, cost Blockbuster everything. The warning was clear. Betting on today's cash cows while ignoring tomorrow's channels is a silent, compounding risk that can bring down even the strongest brands. Eddie Lampert's takeover of Sears and Kmart in 2005 marked a shift from retail reinvention to asset monetization. The focus moved quickly from updating stores to selling off real estate and brands. In 2017, Sears sold its Craftsman tool line for $900 million, trading heritage for cash. Stores saw little reinvestment. By 2016, foot traffic at Sears and Kmart had dropped 6% year over year. Shoppers found empty shelves and outdated layouts, drifting away as the brand's relevance faded well before bankruptcy made headlines. JCPenney's decline took a different route. In November 2011, Ron Johnson, known for Apple's retail success, was brought in to overhaul the company. He abandoned coupons in favor of everyday low pricing, expecting loyalty to follow. Instead, regular customers felt lost. Coupon use collapsed and the Net Promoter Score, a key loyalty metric, fell 12 points, from +14 to +2. By April 2013, Johnson was out, but the brand's trust deficit lingered and loyalty had been damaged. In both cases, early warning signs appeared in the numbers: falling store traffic and plunging loyalty scores. These metrics shifted long before the public reckoning, offering a quiet but clear signal of cultural drift and customer alienation. 6 numbers can reveal a brand's true health before anyone else notices. When research and development spending drops more than 10% year over year, it is a sign that innovation is being starved. A sales decline of over 5% across 12 months means customers are drifting away faster than they are being replaced. If operating margins shrink by more than 2 percentage points, profit is leaking out of the business even if revenue looks steady. Watch the customer acquisition cost. When it rises above 1.5 times the lifetime value, the company is paying more to win customers than it will ever get back. A digital engagement gap, like website traffic or app usage lagging the industry average by 15% or more, signals a brand falling behind where it matters most. And when it takes longer than 48 hours to respond to a crisis, damage spreads unchecked. These 6 thresholds are your early warning system. Cross 2 at once and history shows trouble is on the way. Every founder and growth team needs a set of tools they can put to work right now. The first fix is to set a hard floor on your innovation budget. No less than 8% of revenue goes to research and development, even during lean quarters. This is not just a tech company rule. It is how brands like Nike and Zara keep their edge while others fade. Second, redesign incentives for leadership. Tie bonuses to multi-year targets and build in a clawback. If key metrics like margin or NPS slip for 2 years, those bonuses come back. This keeps everyone focused on long-term health, not just this quarter's numbers. The third step is to launch a 30-day sentiment loop. Every month, survey employees and customers, then act on the results within that same window. Small problems stay small when caught early. Fourth,
Audit your sales and marketing channels every quarter. Look for leaks, outdated tactics, or missed opportunities before they become fatal. Finally, run a crisis drill every 60 days. Gather your team, pick a scenario, and practice the response. When a real crisis hits, speed and clarity will protect your reputation. These 5 moves are the habits that keep brands alive when the market shifts. They are a budget floor, incentive redesign, a sentiment loop, channel audits, and crisis drills. Right now, every thriving brand faces the same silent risks. Small mistakes compounding behind the scenes. Survival isn't about luck. It's about spotting warning signs before they become headlines. The brands that last are built by leaders who never stop asking, "What are we overlooking today?" Share your thoughts below.